Imagine waking up tomorrow morning, right, and discovering that 5% of the world's energy supply just, well, vanished.
Yeah. Legally erased.
Exactly, with a single stroke of a pen. In a normal commodity market, that sounds like, I don't know, a bizarre hypothetical. But if you're tracking the global nuclear fuel supply chain, that isn't a thought experiment.
No, not at all.
It just physically happened in Niger. And it is sending shockwaves through a system that is, frankly, already stretched to its absolute working point.
Oh, it completely upends the models. I mean, you have utility companies scrambling, governments panicking, and this market structure is just fundamentally shifting under our feet as we speak.
Which is exactly why we're here. Welcome to this custom-tailored deep dive. If you're listening to this, you already know we don't just, read headline numbers. We're here to tear apart the mechanics of the market.
Right, getting into the physical reality of it all.
Exactly. So today is Friday, June 5th, 2026. And our mission is to cut through all the daily noise and isolate the raw, fundamental forces driving the global uranium market today. Because what's happening beneath the surface is vastly more intense than what the basic financial tickers suggest.
The surface numbers are incredibly deceptive right now. I mean, they look calm, but the undercurrents are violent.
Yeah, so let's establish that baseline first. The Friday closing spot price for U308 sits at $86.12 per pound.
Which is a solid number.
Yeah, we're up 1.3% week over week and up 9.1% year over year. If you look at the chart for May, the price has held remarkably steady in this $85 to $86.50 range throughout the entire month. It's not some parabolic spike.
It's a
steady, relentless grind.
And that grind right there is the vital signal. Because the central thesis we really need to carry through our entire analysis today is this uranium's current narrative is no longer driven by short-term spot speculation. The market is being dictated by a massive structural physical supply deficit. And that deficit isn't a forecast anymore, It's a reality acting as this incredibly durable concrete floor under the price.
So if utilities can't trust the stability of the global supply chain, we have to figure out where the pressure is actually coming from.
Exactly.
To understand the strength of that price floor, we first have to look at the massive hole the market is trying to fill. And we have a huge institutional update on the demand side.
We do, yeah. And it shifts the goalpost entirely.
Yeah.
Goldman Sachs has formally added small modular reactors, or SMRs, to their long-term uranium demand model for the very first time.
Wow. Okay.
Yeah. They're officially forecasting 46 gigawatts of SMR deployment by the year 2045.
Okay, I need to stop you there because we have to challenge this a bit. 2045 is, well, it's 2 decades away.
Sure.
And right now, outside of a few test cases, SMRs are largely still on the drawing board. So how much of this Goldman Sachs model is just Wall Street modeling vaporware versus actual shovel-ready demand?
It's a fair challenge, but you really have to look at the catalyst here. Tech companies are desperately seeking baseload, carbon-free power for AI data centers.
Right, the AI boom.
Yes, and traditional grid infrastructure just cannot handle that load. Goldman isn't projecting vaporware. They're modeling the required energy density for the next 2 decades of computing infrastructure. In physical fuel terms, that 46 gigawatts translates to a staggering 62 million pounds of new localized uranium demand.
This is huge.
It's a 17% upside to their previous estimates, just from SMRs.
But the headline number, the one that actually drops your jaw, is the aggregate. What is Goldman projecting for the cumulative supply deficit?
So between 2025 and 2045, they project a cumulative supply deficit of 2.3 billion pounds.
2.3 billion. That is...
It is staggering.
It is. I think the key to understanding how SMRs create a deficit of that magnitude is visualizing the architectural shift, right? Historically, building a nuclear power plant has been like building a massive, centralized mainframe computer back in the 1970s.
Oh, that's a good way to look at it.
Yeah, you pick one secure location, you spend 10 years and $10 billion, and it powers an entire grid. SMRs completely break that model.
They do. They totally decentralize the entire fuel cycle.
Right. So instead of building a 1970s mainframe, we're basically building a network of cell phone towers.
Yes.
You manufacture these small reactors on a factory assembly line. You drop one next to a massive AI data center in Virginia. You drop another next to a remote mining operation in the Arctic. But because you're deploying hundreds or thousands of them across the map, you suddenly require this vast geographically distributed network of fuel.
Which is, quite frankly, an absolute logistical nightmare for the supply chain, but a profound demand driver for the commodity. You're shifting from a few massive consumers buying in centralized bulk to a distributed network of incredibly hungry, isolated consumers.
Yeah.
And when an institution with the capital weight of Goldman Sachs stamps a £2.3 billion deficit on the market, it fundamentally alters the baseline price required to incentivize any mining company to, go out and look for new material.
Which naturally pivots us to the supply side. Because if you are a listener holding a stake in this market, or say, if you run a utility company, and you see a £2.3 billion hole approaching, your immediate assumption is that every mining company on Earth is frantically turning on the spigots.
But they aren't.
They aren't. The world's current reliable supply is actively shrinking.
This is where physical geology collides with brutal geopolitics. I mean, we are watching jurisdiction risk play out in real time.
Let's bring it back to that 5% I mentioned at the top of the deep dive, Niger.
Right.
On May 18th, Niger's cabinet abruptly revoked the Arlit uranium concession. They didn't just tweak a tax rate, they ended a 58-year tenure by the French state-owned company Orano.
Half a century.
Yeah, half a century of established operating history and infrastructure just erased by a single cabinet vote.
It is the ultimate manifestation of sovereign risk. And the defiant posture of the Nigerian government is escalating. They are actively ignoring an ICSID freeze order.
And ICSID being the World Bank's international arbitration body, right?
Correct. So ICSID issued an order regarding another major mining operation in Niger, SMR. The order effectively freezes all exports while the legal arbitration is ongoing.
Okay.
But the government in Niger is simply disregarding the tribunal. They're physically exporting the uranium anyway.
Let's unpack the reality of that, because it's one thing to say you're defying a World Bank order on a piece of paper in some office in Paris or Washington. But physically, what does that actually mean on the ground?
Oh, it's wild.
It means you have heavy transport trucks carrying highly regulated radioactive material moving across the Sahara without international regulatory blessing.
The logistics of defying that order are just staggering.
Exactly. Like, who is insuring those trucks? If you're a legitimate Western shipping company, you won't touch it. If you're a European utility company, you can't legally buy it.
No, you absolutely can't.
It forces that material into the shadow market. So for the utilities in the West that rely on transparent legal fuel cycles, roughly 5% of global uranium supply is now functionally dead to them. It has moved entirely into the red zone.
And if you're a European or American power provider, you have to physically wipe that 5% off your risk models. It's inaccessible.
So if utilities can't trust West Africa, there has to be a flight to safety, right? Surely the undisputed heavyweights of the industry are stepping up to capture that market share. Let's look at Kazakhstan.
The Saudi Arabia of uranium.
Exactly. Their state company, Kazakhstan, is the largest single producer on Earth. They just released their Q1 2026 financials, and their net profits plunged 56% year over year.
A 56% drop is stunning when you consider the macro environment we're in.
Especially since their actual physical production of uranium went up 9% in the same period.
Right.
They pulled more material out of the ground into a higher pricing environment, but their profits collapsed. Explain the mechanics of that. How does a company lose half its profit while expanding production?
It comes down to fiscal jurisdiction risk. Even if your geological assets are the best in the world, the state can alter the financial gravity overnight.
Wow.
Kazakhstan implemented an 18% mineral extraction tax, or MET, specifically targeted at high-volume producers.
Wait, an 18% top-line grab?
Yes. And the way a mineral extraction tax works is brutal, because it taxes the volume of what you pull out, not just the profit you make at the end of the day.
Ouch.
So that single tax policy wipes out an estimated 8 to 12% of Kazakhstan's EBITDA right off the bat. The government is essentially confiscating the margin.
Which creates a massive disincentive. I mean, why would Kazakhstan spend the capital expenditure to drill new well fields and expand production to rescue Western utilities if the Kazakh government is just going to tax away all the upside?
Well, they won't. They're financially constrained by their own government. So the most dominant low-cost producer in the world has had its competitive advantage systematically eroded by tax policy.
If you're listening to this and looking at your own local utility grid, this timeline should deeply concern you. If they can't legally buy from Niger, and Kazakhstan is mathematically disincentivized from expanding production, who is actually riding to the rescue? Where is the safe haven?
The capital is violently pivoting back to low-risk gold standard jurisdictions, specifically Canada. But, a pivot in capital doesn't immediately yield physical fuel.
Right. We're talking about the Athabasca Basin in Saskatchewan. This region is famous for having the highest grade uranium on the planet. And we have two massive developments from the companies attempting to build the next generation of mega mines there.
Yes, NexGen and Denison.
Let's start with NexGen Energy and their Rook-I project, which sits on the Arrow deposit. They just received their official construction license. Groundbreaking is scheduled for this summer.
The Arrow deposit is arguably the most important undeveloped uranium asset globally. It is an incredibly dense, high-grade ore body.
And they've secured the war chest to actually build it. We're not talking about some exploration company hoping to find rocks. They are fully capitalized. They just completed a CAD $953 million equity raise. On top of that, they have formal expressions of interest for $1.6 billion in US dollars for project financing. And utilities are already lining up their forward sales commitments, just doubled to 10 million pounds. Utilities are pre-buying fuel that is literally still trapped under the Canadian tundra.
It is a remarkable financial posture. They have completely de-risked the balance sheet for the construction phase.
Then you look right next door at Denison Mines. Their Phoenix project also just received construction approval, and the grade they're working with is absurd, an 11.7% average grade.
Which is unheard of in most base metals.
Yeah. To put that into perspective for you, most operating mines around the world are processing BERT that contains a fraction of 1% uranium. Denison's project is practically glowing, but they aren't building a traditional mine.
No, they're utilizing in situ recovery, or ISR.
Let's make sure we explain how ISR actually works, because it radically changes the economics. Instead of digging a massive, mile-wide open pit crater or sending miners thousands of feet underground in elevator shafts, ISR is more like, well, operating a specialized water well.
It's highly surgical. You drill a pattern of injection and recovery wells directly into the ore body. You pump a specialized, slightly acidic or alkaline solution down into the ground.
Okay.
That fluid naturally dissolves the uranium directly within the porous host rock. Then you simply pump that uranium-rich liquid back up to the surface processing plant.
So it skips the massive earth-moving costs entirely? You aren't crushing millions of tons of waste rock?
Exactly. Which makes it incredibly cost-effective and environmentally lighter. The regulatory approvals for NexGen and Denison represent a massive victory for the Western supply chain.
But wait, let's look at the calendar and apply some friction to this whole Western rescue narrative.
Yeah.
Building a megamine in northern Canada isn't a software patch.
No, it's not.
NexGen breaks ground this summer, yes. But the timeline to construct the shafts, the freezing infrastructure, the processing mills, it takes 4 years. That means NexGen's very first production won't hit the Martin until roughly 2030. Denison is targeting mid-2028 at the absolute earliest.
You've hit on the critical vulnerability of the market right there. The cavalry is fully funded, and they have their permits, but they are stuck in the mud of construction timelines.
So every single day between now and 2030, that 2.3 billion pound deficit Goldman Sachs modeled is just compounding. The utilities can't wait until 2030 to fuel reactors that are running today.
Exactly. The extended timeline for these Canadian megaprojects acts as a vice grip on the interim market. It guarantees that the global supply will remain incredibly constrained for the rest of this decade.
Which completely flips the dynamic of who holds the power. If future supply from Canada is half a decade away and current cheap supply from Africa and Central Asia is risky or taxed into oblivion, then immense, almost unquantifiable value suddenly shifts to the companies that are actively pulling rock out of the ground in safe jurisdictions right now.
The incumbent producers hold all the leverage. I mean, they've already sunk the billions of dollars into capital expenditures a decade ago. They already have their permits. They are producing into a market starving for immediate pounds.
Let's look at Cameco. They are the blue-chip titan of Western uranium production. Their Q1 2026 revenue is up 7% to $845 million. Their adjusted EBITDA is up a massive 44%.
And notice what you're doing with that cash flow. They're aggressively consolidating their safest assets.
Right. They just increased their stake in the massive Cigar Lake mine to 57.4% by buying out TEPCO's 5% share. So when the rest of the world is desperately trying to find reliable supply, Cameco just bought an extra 5% of one of the highest grade operating mines in the world.
It's a strategic masterstroke.
Yeah.
But what's equally important is how they handle operational friction.
You're talking about the water issue.
Yeah.
They had a brief flooding disruption at their McArthur River and Key Lake operations recently. And in underground uranium mining, water is the absolute enemy.
The worst.
But Cameco successfully navigated it, managed the inflow, and resolved the issue entirely by late May. They didn't even have to change their full-year production guidance. It was just a technical hiccup.
And that is the very definition of operational resilience in a top-tier jurisdiction. An underground flood happens, they deploy world-class engineering, fix it, and move forward. Contrast that with the geopolitical crisis in Niger, where a 58-year established operation is just legally annihilated overnight.
Yeah, the premium on a safe jurisdiction has never been higher. Then we look over at Paladin Energy. Their Langer Heinrich mine in Namibia is absolutely humming. They just released their quarterly numbers. And in an environment where everyone else is struggling to meet targets, Paladin actually raised their full year 2026 production guidance.
This is phenomenal.
They're now targeting 4.5 to 4.8 million pounds.
And the metric that matters most for Paladin right now is their cost of production.
It's sitting at $40.30 per pound.
Let's contextualize that against the headline number we started with.
Let's do the exact math, because this is where the theoretical market deficit translates into violent free cash flow. If the spot price of uranium is sitting steady at roughly $86, and Paladin's all-in cost to produce a pound is just over $40, they are pulling in roughly $45 of pure margin on every single pound they pull out of the ground.
When you are producing approaching 5 million pounds a year, a $45 margin generates a truly extraordinary amount of free cash flow. This is why the current reliable producers are the immediate victors of this structural setup.
Yeah.
They are harvesting the rewards of an $86 spot price today, while their future Canadian competitors are bleeding capital in a 4-year construction phase, and their geopolitical competitors are fighting over taxes and tribunals.
It is wild to step back and look at the whole board. The headline number, that $86 spot price, it looks boring. It hasn't moved much in a month. But underneath that static number, the tectonic plates of the global energy market are shifting violently.
If we synthesize this entire landscape for the listener, the framework becomes undeniably clear. First, the demand side has permanently leveled up. Goldman Sachs has put the institutional stamp of validation on a 2.3 billion pound deficit, driven fundamentally by the transition to SMRs and the insatiable power demands of AI. We are shifting from massive centralized reactors to a distributed, decentralized network of power.
The cell phone tower model of nuclear energy.
Exactly. Second, the traditional sources of cheap international supply are vanishing from Western utility spreadsheets. Niger is functionally offline for the West due to sudden nationalization and the logistical impossibilities of evading international arbitration. Kazakhstan is systematically eroding its own expansion incentives through aggressive extraction taxes.
Right. And third, the rescue party is delayed in the snow. The massive, high-grade Western megamines like NexGen and Denison are fully funded, permitted, and utilizing brilliant technology like ISR.
But they are trapped by the physical realities of construction. 4 years of pouring concrete and sinking shafts before a single new pound of uranium hits a reactor.
Which leaves the incumbent, reliable producers like Cameco and Paladin in an incredibly dominant cash-generating position.
Yes.
They are sheltered from the sovereign risks of Central Asia and Africa and completely insulated from the capital expenditure risks of the new developers. The structural supply deficit is measurable, it is physical, and it is acting as a concrete floor under this entire market.
It really makes you realize how fragile the illusion of a stable market can be. You look at a stock ticker, you see a flat line, and you think everything is calm. But the reality is that the margin of error for the global nuclear fuel supply chain is sitting at exactly 0 right now.
You absolutely have to look past the ticker. The physical mechanics dictate everything. Which leaves me with one final lingering question, something for you to ponder long after this deep dive ends. We just saw 5% of the world's supply vanish from the reliable market with a single cabinet vote in West Africa, forcing utilities into a panic. If the balance of global supply and demand is already this incredibly tight, if we are already facing a 2.3 billion pound hole over the next 2 decades, what happens if another sudden geopolitical shift cuts off Western access to Central Asian supply entirely? Where do the world's reactors get their power then?
That is the multi-billion-dollar question keeping the entire industry awake tonight.
Thank you so much for joining us for this deep dive. Keep looking beneath the surface, keep questioning the world around you, and we'll see you next time.